The information flow is endless, and with so many sensational headlines, changing policies, and market fluctuations, it can be tough to keep up with what's most relevant to you as a real estate investor. In Boardroom Brief, we endeavor to discuss and provide our point of view and insights on relevant topics that matter to Greybrook, our investors, and the broader real estate community. Our goal is to provide you with expert opinions in 20 minutes or less.
Sasha, welcome back to another episode of Boardroom Brief.
Thank you.
Today I want to talk about something that continues to be topical. It's the US-Canada dynamic. And just for today, I want to set aside the tariff and trade war talk and just discuss for a little bit the true unique nature of each market. Canada and the US have been active markets for Greybrook for quite some time. This year, we're acquiring assets in both countries. Now, despite our geographic proximity, there's still a lot of unique elements of each market, economic drivers, housing dynamics, etc. Can you touch on, from a high level, how Greybrook assesses opportunities in Canada versus the US?
There's a trade war. I will park it. I remember the first conversation we had maybe not too long ago, early in the year. I brought out my crystal ball and you asked me about, the idea of tariffs because they were just being talked about. And I said, I don't think it's a thing. Like, I think it'll figure itself out in a few months. And here we are. So for today, we'll kind of park that part of the discussion. So I guess the first thing I want to say is that, we have been acquiring assets in both countries. We continue to be very bullish and long on both countries. So we have not, as a result of whatever's happening macroeconomically, decided, we don't want to be in the US. Now everything's market specific, right? So there's obviously certain places and that we'd like to focus, and even within certain categories of housing. I would say that some of the key differences between the two, and I'll kind of try to tackle it from the top down. So first, macroeconomically, there's the obvious. The US is a lot bigger, more liquidity, bigger economy, more diversified economy, bigger population than obviously than Canada. In today's macroeconomic environment, it's also proving to be a lot more resilient. Your typical household is less leveraged than a Canadian household, therefore less interest rate sensitive. So the housing markets remained, subdued, but more resilient than the Canadian housing market. Inflation's been more stubborn in the US than it has in Canada. So interest rate deceleration has been less in the US than it is in Canada. The Fed as recently as last meeting, I think they have another meeting next week, but last meeting kind of forecasted potentially 2 more cuts. The market's pricing in maybe 1 more cut. You're seeing the bond market reflect that. So there's a lot of dynamics that are showing resiliency in the US economy, notwithstanding what we're seeing kind of geopolitically and macroeconomically. Why that matters for us is that, when you're deciding what type of investment to make in our residential world that we focus on, timing matters a lot, right? And right now in the US, we're looking at the dynamics, macroeconomically, and we're kind of making a call on being in the rental market space, not so much from a development perspective. We have a development portfolio and we have to deal with the challenges that we see within it. But where we're deploying new money is looking at the value add space, as we call it. So it's buying existing apartments and engaging in a improvement program, investing in these assets and improving them and hopefully migrating rents forward. The reason is because we're in a very difficult environment based on where interest rates are, based on where inflation has taken the cost of inputs for construction. And it's made it such that new construction is very, very difficult today, if not impossible, based on these macroeconomic conditions. So what that means is that to fulfill the housing requirement that is consistent, right? And one thing I want to draw people's attention to, and I've said this before in different places, is, in Canada, when we have a high level of immigration, based on where opportunities are, based on the type of lifestyle people are seeking, they're kind of choosing between 2 or 3 markets that have a couple million people in their general vicinity, The US has 40 of those.
Sure.
So you get a much more dispersed population base. So there's many more markets we can participate in. But what we're focusing on and why we're focusing there is because there is a new housing requirement. Given where interest rates are and given inaccessibility of the US operates on mainly 30-year fixed mortgages.
Yeah.
So in Canada, you're getting, 5-year and then it resets. Okay. I'm not talking about the amortization period. I'm talking about the term of the
Yeah.
mortgage. In the US, you can lock in your 30-year money. Well, people that did that in 2020, 2021, 2022 are way better off to hold their mortgage than move. And you can't port them
No.
the same way that you can here in Canada. So what that creates is an environment where people looking to buy new homes are kind of, there's a dearth of supply on the basis of people staying in their homes because of where rates have gone. You have a dynamic where new construction is challenging, especially in multifamily, given the costs and the cost of construction loans and things like that. And therefore, where this housing can come from to service a wide swath of the population is buying these older, what I'll call underappreciated assets. They've been neglected in some cases. They have been underinvested in, and now taking them and improving them significantly so that you can kind of reach a large swath of the population and obviously at higher rents. So there's a lot of demand for that type of product. So we feel really great about that type of strategy specifically now, given the macro economy. Not to say that one day, it won't be ground up rental or condo, but today this is really the opportunity. In Canada, it's a little bit different. So in Canada, we have largely been what I'll call a for sale market. The US, rental is a very common type of housing. Most cities don't have a lot of condominium. They have mainly apartment buildings. Those are rental buildings. In Canada, it's quite the opposite. So you have mainly condominium product and much less what we call here purpose-built rental. And that's created a bit of a different dynamic. So aside from the macroeconomic differences that we've kind of touched on, in the housing market, we have a really frozen housing market. And what the main driver of that, obviously, interest rates are where they are. A lot of the new construction is, I don't want to say fueled by investor capital, but there's people that are buying things for the purposes of renting them in the future or selling them in the future, or whatever the case may be. And in environments like this, where you've seen a pullback in the market, you've seen a pullback in investor participation in the market. That coupled with very high interest rates that's testing affordability in markets like Toronto, Vancouver, Montreal, and others, it's really, really killed the new construction stock. Okay. So you still have large population growth. So you still have a lot of demand for housing. You're just not producing enough of that housing today. So what does that mean in terms of an investment strategy? It means that on a longer term basis, we're still very bullish on both high rise, whether that be in the form of purpose-built rental or condo, as well as low rise. That housing is required for the type of household formation that we have in cities like Toronto. But the timing matters a lot. So are we eager right now to buy something that I can start selling units in a year? No, because as we sit here today with everything that's happening economically, I can't tell you whether it's 12 months away, 24 months away, or 36 months away. Hopefully not 36, hopefully closer to 12, but we don't know that, right? So what we do know is that over the long term, given how many people are coming into Canada, even with the pullback in immigration, and how undersupplied our new housing inventory is, right? And that's, you can read anywhere in the news, this is what they're talking about. I know that there will be a demand and we need to fulfill that with a supply, and that's going to make sense mathematically. I just can't tell you within what time frame. So as we stand here today, the things that we're focused on buying, whether high rise or low rise, are things that have a much longer, as we call it internally, fuse, right? A planning period. And then, it might be 3 or 4 years before I'm selling my inventory, because I believe that will coincide with a huge pent up demand that, obviously will benefit from that from a sales perspective. And in the meantime, by buying things earlier on in the cycle, you're actually making money through the active value creation of development. You're not just buying a piece of dirt that's ready to go and you're sitting on it. You're buying something that we'll call raw,
Sure.
and you're moving it through a process and you're adding value through that process. So when the market does heat up, you're in a position where you have the opportunity to go out and sell the homes and build them as you've initially envisioned. Or frankly, if the market heats up, there's going to be a lot of developers that are going to be looking at something that they can be in market at that point to capitalize on the momentum. And you'll have land where you've added a lot of value that's now ready to go, where you can potentially sell all, some combination. So we like these type of opportunities that offer us a level of flexibility that are over a longer duration. And I know that's, sometimes it's difficult for investors when all this stuff is happening and you come up to them and you say, hey, listen, I have this great deal that I think we should buy, and here's all the great reasons. But inside, people are feeling, I don't know, I'm a little uncertain, I don't know what's happening in the world. Then if that's how you feel, then you're better off to be out of the market.
Yes.
If you want to be in the market because you believe what we believe in terms of the long-term overall health of our market, then this is the kind of thing you should be buying, right? Not something where, hey, look, it's 3 years because I'm buying it fully approved and I'm going to sell them tomorrow and I'm going to build them the day after. It's just not realistic. And that's not where you're going to make the type of return you're looking for.
Yeah, I think a lot of investors that are still keen, the conversations I have, one thing that they realize is, and we obviously agree on this point, is I'm not buying the today of real estate, right? And when you're buying these long-term, value cycle projects where it's truly raw land, you need to service the land, you need to take it through draft plan, secondary plan, etc. I think investors realize that this is like the pre-revenue round in like the VC world, right? I'm buying something at a truly entry-level price, especially what we're paying now for acres of raw land in prime areas. It's a great opportunity.
And if I may, I think on that point, it's important to say, because, as I sit here today, and I'll see if I can articulate this the way it works in my mind, because the words might not come out the same way. But if I'm thinking back to Sasha 5 years ago, when you're looking at the trends that were more prevalent back then, I don't think it was as definitive directionally where it goes. So what I'm trying to say is, 5 years ago, there's a 50-50 chance that interest rates were going to go up or down, based on a pretty stable macro economy. As we stand here, in 2020, I'm pretty sure they're going to go up.
Yeah,
because they were at zero. Right? So like the visibility we have today with kind of peak uncertainty, I guess of course it could get worse, but it's unlikely. So like if I was placing a bet today, I would probably bet, and this isn't just blind hope, this is based on everything we've seen in history and everything else, it's more likely to get better than it is to get worse from where we are today in the cycle. And if you believe that, then the timing becomes very important, right? Because it's not just about always thinking long term. It's also about, sometimes the right thing to do is to do nothing.
Yes.
And we probably went through a couple years where we did not nothing in terms of new investments, but not a ton.
Yeah, less than usual.
For sure. Yeah. And now today, like if we had an unlimited amount of capital, we would probably be buying a lot more. And luckily we have access to capital, so it's not unlimited, but it's a good access to capital. So we're getting to capitalize on certain opportunities. And the timing as we look forward is better today than maybe had I been standing here 5 years ago. Obviously we thought things were great, but it was a little more ambiguous. I don't know if that made sense.
No,
but
it does. I think so. I think that, regardless of sort of which side of the political spectrum you lean on or which economist you follow, I think there seems to be this developing consensus of the fact that we are heading towards resolution in whatever way you want to define what resolution is, right? And I think for a lot of investors, resolution is just some form of certainty, some form of direction of this is the future, whether you agree with it or don't agree with it, or you think we could be in a better place. At least an element of certainty, I think, is where we're headed. We crystal balled this 6 months ago, but in the next quarter or two, I think we'll be there. I want to touch on a little bit of something that I also frequently discuss with investors, and that's the nature of bureaucracy on both sides of the border, right? So frequently here, a lot of developers and institutional players will we'll say there's the red tape, man. The red tape, it's just so prevalent. How do you find working south of the border? You know, are there things we could learn from some of the ways that they encourage development or encourage capital deployment there?
Um, yes, but I'm going to answer the question in a different way that maybe people wouldn't expect. It's a double-edged sword, okay? And I'm speaking as an investor, not a person who needs a home, okay? Because like obviously, if you're a person who's looking for a home, the more, the better,
Yeah,
right?
yeah,
I mean, it's going to help me with
sure.
more better pricing, right? If there's less scarcity and all these things, okay? So I'm speaking as an investor, and as an investor, it can be a double-edged sword. So let me give you an example. In markets like Atlanta, in markets like Miami, where any U.S. market we operate in, because they're all very similar, the lack of bureaucracy and the ease within which you can achieve approvals makes it such that on the supply side, when things are good, there's a lot of liquidity, as we've already talked about in the U.S. market, and it's pretty easy to get your approvals. So there's a lot of building that's happening, right? If a city's growing, you got population growth, you got a bunch of developers in there, they're buying land, they're building things, and they can fire these things up in 3 or 4 years. Unlike Canada, as we've talked about, where you got a couple cities that have 2 million plus people. In the US, you have so many of them.
Sure.
With different opportunities and things like that. There's more mobility. So the result of that is cities can grow and cities can shrink depending on what's happening, right? You saw during the pandemic, right? California, everybody moved to Texas.
Yeah.
New York, everybody moved to Florida, and maybe it's reversing now. But the point is that migration trends are very different. So what can happen in a situation where approvals are much more difficult is these markets can get overbuilt, and they can change on a dime in terms of population growth and flow of people. And then you could be caught in a situation where you have much more supply than you have demand. That's just, I'm not going to say impossible, but way less likely
For sure.
in a market like Toronto because of the red tape, because of the bureaucracy, because of how difficult it is to get supply to market. You are almost in a forever deficit as it relates to the amount of housing you can bring forth to match that demand. And that generally will provide a level of stability in pricing. And yeah, we're going to live through times like this where pricing doesn't look so stable, right? And dynamics will change. But believe me when I tell you this, whenever it is that things start to make more sense based on where interest rates go and how people feel about economic stability, you're going to see upward pressure. There's no question. I don't know that that happens as regularly in US markets because sometimes that oversupply has to clear and it can take a long time. So again, yes, more bureaucratic, but kind of like the way our banks survived the financial crisis is a lot because we are too conservative and have too many checks and balances, and it probably kept us out of a lot of trouble. So I would say in housing, I'd offer up, as frustrating as it is. And I know it's frustrating for investors who, look at a situation where we say, okay, we think it's going to take us 3 years to get to, milestone A, and then it takes 5. And it's frustrating. And that's not us lying. That's things in real time getting worse. And you've seen it in the headlines, right? It's only gotten worse and worse and worse. I think it's going to get better, right? So today, more than ever, I think in Canada, there's a lens from the press right through to the government where they've kind of realized, man, if we're going to get out of this affordability crisis, this lockup, we've got to get more supply to market. Yeah. And I think there's a realization that part of the problem is that, it takes you 3 years to get something approved. So I don't know that it's going to be an overnight change. And I'm hoping that when the market heats up again, it doesn't go right back to the old pattern of, taking a long time. So I expect it to get better, not worse. So when we're out in the market, I think now with depending on when we air this, with a deal that's kind of 10 years. And I think, like we said, it's the right thing to do at this particular time. But a lot of people look at it and say, yeah, 10, but it's really 15 because, you're wrong. And we're saying, okay, but right now I think we're building in a timeline that is probably a lot worse than it might be. Not saying that that's going to happen, because I see it getting better, not worse. Whereas 3 years ago, I just saw it get worse, right? If that makes sense. So bureaucracy is a big, big deal. But as an investor, I think, we got to live with it. And it's part of, in a way, what gives us stability in the market. If that makes sense.
Yeah, listen, I think it creates some element of fundamental confidence. If I'm a homeowner, if I'm a developer, right, I have some sort of lens into, okay, everyone's dealing with what I'm dealing with. I know how supply comes to market. I can plan for it accordingly. I want to wrap up with just one question that looks at the other side of the coin of dealing in both sides of the border. If there's one sort of strategic insight or best practice that you think we've learned as a firm that applies to both sides, if there's one thing you could point to that says, okay, here's the benefit of being a firm that can operate on both sides of the border, what would you say that is?
I think really understanding how to analyze markets from a broad perspective. So what I mean by that is, when you're operating, let's say you only operate in Toronto, then you really only have to be concerned with the way things work here on a very micro level as it relates to the site and comps and things like that. Like, you can almost underwrite, you could take for granted sort of the macro a little bit. And focus just on like the piece of dirt you're buying. So you don't get as much practice in trying to take that top-down approach to where you invest, because market selection is a pretty big part of it. And doing it across multiple markets, I think, has taught us how to do that, pretty effectively. And I would say the other thing, which I think is a really, really critical piece, is we develop really only in a couple markets, and that being, call it Southern Ontario, and then South Florida, and a couple select markets, so like Atlanta and Denver. So very few. I think developing in these markets, if you're going to pick 5, 6, 10, that's very hard to do, because you really need to you got to be steeped in kind of the local understanding. Whereas the stuff that you do where you're buying apartments is much more macro. Like, it's less about like the parameters around that piece of dirt, because you're not building something on the piece of dirt. It already exists. There's already people renting on it. There's a history, so you can understand the market because it's more about employment and where how people migrate, and what this the city of Atlanta is relative to Houston, and the oil sector is getting hit harder than the airline sector or whatever. But that's a very macro analysis. So investing across both countries in different asset types, I think, really makes you have to be good at that part. And that's not something that I think you would develop if you're just kind of focused on development in a single market.
Yeah, I think that's a great point. Like, if you're sort of just focused on Young and Bloor as your world, and you think you know everything there is to know about Young and Bloor, and you go and make a big bet, there's dozens of other variables you may have not considered or had the foresight to consider, just because you kind of have tunnel vision for being the subject matter expert in that market.
And even if you got it right,
yeah,
I mean, we're in the business of managing capital, right? So we're not in the business of building buildings. I know that that's kind of the byproduct at the end of the day, but we're in the business of managing money. So if I'm managing your money and I can only offer you Young and Bloor, and 5 other things in the Young and Bloor area, then just inherently you're taking a risk, because you don't have a level of diversification.
Yeah.
Because something could happen to Young and Bloor.
Yeah.
And that isn't happening to other parts of Toronto or other parts of Canada or other parts of North America. So I think for us, the evolution of going into the other markets was that, really. It's taking, a look at from the lens of an investor and saying, well, if I'm going to have a broad, more diversified exposure, because things can happen, the more diversified I am, the better. And you can only do that through investing in multiple markets.
Absolutely. Thank you, Sasha. Great conversation.
Absolutely.
Thanks.